Say, I continue to maintain that December will be a good month, and the price action has been far more satisfactory than what we actually anticipated in the beginning of November. Why is December turning out to be nothing short of a dream month? Even in best of the bull market, if you would have seen this kind of a linear move in the small and mid cap stocks and consistent buying on the dip in large cap stocks, and if the bank nifty is marching towards a new record high, for me that is nothing short of a spectacular month. And this outperformance or this strength in India, I think, is here to stay. What are the factors which are at play? Let me just revisit them, and then we'll talk about what could impact the market right now. The factors are at play is that FI buying. And folks, we are talking about 20,000 crore of sudden buying which has come from FIs. The headlines in the month of October was FIs are selling, it's almost like a quit India movement, and the same folks have actually made a comeback. So there you go. The YTD data versus MTD data, the FI buying actually has been strong. B, there has hardly been any news, both locally and globally. Markets, in a sense, have digested election news, mega IPOs, and what we've seen in terms of the earnings downgrade. And third, and the most important aspect, which I think is helping the market go higher, is that typically when you see the year-end phenomenon and when news flow hits a dry patch, the performing markets, they always tend to do well, which is India in this case and Nasdaq in the global market. So I'm not at all surprised. Indian market surely bottomed out. US markets are showing signs of topping out. 3 weeks ago, just about everyone had opinion on the impact of Donald Trump, earnings downgrade, economy slowdown, and the impact of the new RBI governor. All that seems to be settling, and it seems to be settling very nicely. So that's where we stand in terms of the market setup and the factors which are at play. Now we need to understand where are we headed from here, right? Take care. History is past is that we have gone higher. Where are we going from here? I think December is all about strength. Till middle of Jan, when the news flow is not going to be abundant, I think there is a reason for markets to outperform. Because you are right now moving on momentum, you're right now moving on flows, and you're working with an assumption that FI selling, in a sense, which has come back, is here to stay. And the action in small and mid cap stocks is more than heartening. So there is FOMO which is at play, there is FI coming back, and there is bank nifty which is in a clear leadership position. The combination of these three factors will ensure that in the near term, strength remains the real deal.
Okay, so lots of factors that seem to be amalgamating, which is making a case for the markets to go higher or remain pretty steady in the month of December. And just to wrap up yesterday's trading day, the mid-cap and the small-cap indices, they snapped their 2-session losses. We closed below the 100 daily moving average on the frontline index. Yes, you did have banks in a range, although we were around the 53,500 mark. Real estate as well held out quite comfortably. But Nikunj, while of course there are a lot of factors that seem to be supporting us, where do we stand when it comes to the overall valuation metric? Are things looking a little bit stretched at the current juncture? Or if we compare ourselves to, for instance, the Nasdaq, that seems to be far more overheated.
You're right. If you talk about Nasdaq, I think it's only about those magnificent 7 which are doing the trick for, for markets. So I think from that standpoint, it is the magnificent 7. Frankly, this is not the market where you really want to pay too much of attention, and I'm talking about really short term here, next couple of days or next 2 or 3 weeks, too much of attention on valuation per se, because this market is going through what could be called as a momentum tailwind. And typically in a momentum tailwind, the strength in the market actually is based on fundamentals and positioning rather than the macros and valuations. And I'll talk about some themes here, and these are themes which in a sense have really emerged as a powerful theme. So previously when we were at an all-time versus now, what is the big difference? The bank nifty. Previously when we were at an all-time high versus now, or nearing an all-time high versus now on the small and the mid-cap indices, what was the price, how is the price action different? Now you've got, let's say, solar, which has emerged as a very clear theme. The other theme is that defense and railway stocks are taking a back seat. The other theme is that you're seeing serious amount of outperformance now, which seems to be coming anything which has got to do with mid-cap IT or niche IT. So there is definitely a difference in the way how markets are approaching or how markets are positioned in terms of where the previous high was versus now. But this is a market for next 2 or 3 weeks. I'm not saying you should be blinded with momentum, but if you are trading and if you have a view for next 2 or 3 weeks, you'll have to stay with the trend. And it's a good old cliche, trend is your friend, might as well.
Okay, that's the take coming in on the overall markets, but let's also put attention to what's happening on the side of macros, because the wholesale inflation number that has declined to about 1.9%, 89% on an annual basis in the month of November, and that has come down from the 2.36% that we saw in October. Food articles, food products, food inflation has eased as well from that double digit of 11.5% to 8.2%. The trade deficit in November meantime has risen quite sharply to $37.8 billion, and that's been led by the rise in imports, which rose about 27%. Exports as well have dropped to about $32 billion. So Nikunj, just taking stock of all that we've seen on the macro front, for the longest time, food inflation was the big niggling worry. Has the fact that it's cooled off seem a little bit heartening?
It's the wholesale pricing data, and for me actually it's not heartening. I'll tell you why. Because the wholesale growth in the economy has now slipped below 2%, which means that the real economy, and I'm not talking about inflation which gets affected because of food prices, vegetable prices, seasonality. I'm talking about inflation which kicks in because of, let's say, demand in steel, demand in cement. That is not there. Now the wholesale food price index is seasonal, but for me the strength of the economy comes when there is pricing power which is coming back in steel or cement or other industrial related sectors. So for me WPI inflation, I'm not talking about WPI food index here, I'm talking about India's WPI. It means that the industry for the quarter gone by or for the last calculated print did not have pricing power. That in a sense was also captured in the way how the earnings have gone through. So you really want to see wholesale inflation data pick up, because for me that means that the indirect economy seems to be picking up. Then you look at the trade deficit. Of course, mathematically the trade deficit, because the base is large and now you've got size which has become large, the trade deficit would vary, but trade deficit is something which is a function of crude, dollar, and the weakness in rupee, which clearly has impacted the trade deficit for the quarter gone by. It is not going to be a large worry. But the wholesale price data, rather than getting excited, we should ask ourselves that, okay, if the wholesale price data is, if the wholesale inflation is below 2%, that means the economy is just lagging the teeth, or companies are just lagging that advantage in terms of commanding better prices.